Happy Tuesday, everyone. Welcome to another episode of SRT Live. I am your host, Sean, with the Sean Richard Mortgage team here at Guaranteed Rate, and I'm excited to be here with you today. Let me first start off by welcoming everybody. If you're watching in the Powerhouse Facebook group, thank you so much for being an awesome part of our community. If you're checking us out on the YouTube channel or our YouTube channel, make sure that you hit that subscribe button on one of these sides, so that way you can get up-to-date economic mortgage and real estate information at the palm of your hands. So we're going to dive in this week, as we always do, with the week in review. Now, last week was a critical week because we got a lot of inflation data and we got it back to back. So on Thursday of last week, we got CPI, which is Consumer Price Index. This is the inflation report at the consumer level. And this really tells us what we're paying in the stores for services, at the pump, all these things, how that's changing on a month over month and a year over year basis. Now, ultimately, the data showed that inflation was in fact cooling month over month, actually came in line with expectations at 0.2%, and year over year numbers actually beat expectations by 0.1%, coming in at 3.2%. However, it indicated that inflation was not cooling at the fast enough pace, or at least not the pace that the market wants to see inflation cool. And so mortgage rates had a pretty negative response to that after the information was digested over the course of the day. To make matters worse, we did get another inflation report on Friday, PPI, or Producer Price Index, which is inflation at the wholesale level. And this is an important metric because it gives us kind of a leading indicator on what we can expect on consumer prices going forward, right? If it costs a company more money to produce a good or service, then there's a good chance that that cost is going to get passed on to the consumer in some form or fashion, whether it be 100%, 50%, 10%. That's a little bit harder to gauge, but some of that is likely to get passed on. Now, Producer Price Index, PPI, came in above expectations, and inflation as a whole was running higher or hotter this past month, but coming in above expectations was really on the unexpected side. And we saw the market react unfavorably to this news on Friday as well. So we saw some pretty damning news at the end of the week. And I want to share this with you real quick. I'm going to pull up. So here is the chart of mortgage-backed securities. Now, again, you've heard me say this before. You don't need to know a whole lot about this other than mortgage-backed securities dictate mortgage rates, and they move in the opposite direction. So when mortgage-backed securities are going up, then mortgage rates are going down. And then when mortgage-backed securities are going down, we see that mortgage rates go up. So we can see most recently, we had a pretty significant downward slope with mortgage-backed securities, and that has driven mortgage rates higher. So for the past, let's see there, 4 days-ish, maybe 5-6 days, we've seen mortgage rates climb, and we're back to some of the higher levels that we saw towards the end of last year. Now, some good news, and I'll pull this back up. We appear to have potentially stabilized at this level right here. So that's potentially good news. We could bounce off of this level of support, this line right here, and we could move higher on mortgage-backed securities, which would improve mortgage rates. In addition to that, is as we end up with additional inflation reports over the course of the next several months, the results of those are going to have an impact on the direction of mortgage rates as well. So we're in a little bit of a challenging point for the market, but that is likely going to turn around as we head into the end of the year and the beginning of next year. Okay. We also last Friday got consumer sentiment, and this basically remained stable. Came in at 71.2. Last month's reading was 71.6. So staying relatively stable there. And this measures consumer sentiment about the economic environment going forward. So consumers are moderately optimistic, they're not overly excited about the economy and the direction we're headed, but they're not necessarily saying all, they're not screaming all doom and gloom. They're not chicken littling our market right now. Now, moving ahead to this week, we started off with today, we got retail sales. And this isn't normally a statistic that I bring up, except right now, it came in at quite the surprise. So retail sales came in 7/10, came in up 7/10 at 0.4% month over month. And this was a really big discrepancy from expectations. And the reason that this is so important is it's illustrating how resilient the consumer sector really is. And we're going to get more into that here in a moment. We also got National Association of Home Builders Housing Index, and this measures builder optimism or builder expectations with the new construction market going forward. And this actually dropped 6 points to a nice round 50. So anything above 50 is builder optimism. Anything below 50 is builder pessimism. And we came in right on the button at 50. So builders appear to be unsure of how everything is going to go. There's a lot of unknown variables going on in the economy, in the housing market, and it appears through this survey that builders are a little on the fence about how they feel about the new construction market going forward. Now, looking ahead this week, we've got some pretty light data, not a whole lot going on. As always, on Thursday, we get jobless claims, which is unemployment claims. We get initial claims, or individuals filing for the first time. And then we get continuing claims, individuals filing for unemployment or renewing their unemployment benefits. So that's on on Thursday. And then on Wednesday, we get building permits, we get housing starts, and then we also get the Federal Open Market Committee, or the Fed, meeting minutes from their last meeting. And that's really going to peel back the curtain and give us some insight into exactly what narrative was discussed inside the Fed meeting. Sometimes it is market moving, other times it's kind of an already foregone conclusion on what they said. So we do want to pay attention to it, but not focused on it making a giant dent in the market, but just understanding what's going through the Fed's mind as we get through the rest of August and ultimately to their next meeting in September. So that brings us to, what does it all mean and what are we focused on? So right now, I am focused on the economy. We talked about retail sales coming in much higher than expectations, and that does mean that the consumer segment is staying extremely resilient despite high prices. Spending continues to be at a robust pace despite the fact that prices across the entire board have risen. Now, we have seen some prices come down recently. Things like food and fuel have come down. We actually are starting to see oil tick back up, so we're likely going to see gas prices rise a little bit in the coming months if that continues. But consumer spending is definitely been at a hotter pace than expected. We saw a very good example of this recently with Amazon's Prime Day. Their Prime Day, or days in this case, was an absolute rampant success. And there was, I don't remember the exact dollar spent, but it was one of their best Prime Days that they've ever had. And so that is just one more illustration of the economy staying very resilient in the face of all of the economic upticks in costs and turmoil that we have going on. Next, the other thing that we're focused on is we're going to turn our attention to the next Fed meeting in September. So the Fed does meet in September, and with CPI and PPI coming in very strong, it's going to be interesting to see what the Fed decides to do in September. And we do get one more inflation report later this month, and that's going to be PCE, or personal consumption expenditure. The importance of this report is PCE is the Fed's favorite measure of inflation, so they're going to be paying extra close attention to that. Now, the expectation is, because we saw CPI come in a little bit hotter, We're likely going to see PCE come in a little bit hotter as well. And so this could lead the Fed to decide that they need to do more in order to continue to curb inflation. Earlier, I mentioned that inflation does not appear to be coming down as fast as the Fed would like. Ultimately, they're seeking to get core inflation from the roughly 4.7 level it's at down to 2%. And it's going at a much slower pace. And they may feel that they've got to do more work, which ultimately means increasing the Fed funds rate even higher than it already is. The unintended consequences of that would be higher prices in some segments of the economy. But just as a reminder, the Fed funds rate does not have a direct impact on mortgage rates. The Fed funds rate is primarily dealing with short-term interest rate or unsecured products, credit cards, lines of credit, auto loans, shorter-term products, and not so much directly impacting mortgage rates. Now, ultimately, since the Fed funds rate changing does impact the economy, and the economy impacts mortgage-backed securities or mortgage bonds, which ultimately influence interest rates, there is an indirect impact, but it's not a direct correlation. Now, with PCE coming out, we're going to keep a close eye on that. That comes out later this month, and then we may even get a couple of additional inflation reports prior to the Fed's meeting. We'll have to take a look at those dates and see where we land there. But ultimately, we're keeping an eye on the strength of the economy. One other note, I talked about strong consumer spending. We also are going to keep a very close eye on the labor market and look at the jobless claims on a weekly basis, as well as the Board of Labor and Statistics monthly jobs report that shows us job creations for the prior month. Those are all details and statistics that we want to pay close attention to, so that way we can start to forecast where we're heading, because once we can do that, we can start to implement strategies or processes to make sure that we can weather the changes in the economy and ultimately our real estate and mortgage market. All right, well, that is all I have for you today. If you are a real estate agent watching and you haven't signed up for our private Facebook group through Powerhouse, make sure that you leave a comment below with your name and email address, and I'll make sure that we get an invite out to you. Again, if you're watching on our YouTube channel, be sure to hit that subscribe button, and that way we've got the information coming directly to you. If you're a home owner or a home buyer and you just want to better understand the current real estate market, reach out to my team. You've got my contact information right here. You can also leave comments down below, and I'll be sure to reach out to you to answer any questions you have and help you navigate the ever-changing market. Until next time, again, I am Sean with the Sean Richard Mortgage Team. Thanks so much for joining me on this episode of SRT Live. Have an amazing rest of your week.